Before banks, the safest place for a fortune was not beneath the floorboards. It was inside another person's promise. Imagine that you are a merchant in medieval Venice. You have sold a cargo of spices and now need to purchase wool in Flanders. You could fill a chest with silver coins, hire guards, load it onto a ship, and hope that thieves, storms, and customs officers leave it alone. But the chest creates a second problem. Venetian money may not be accepted at its full value when you arrive. Every city seems to have its own coins. Some are worn, some are clipped, some contain less silver than their appearance suggests. Before buying a bundle of wool, you may have to pay a specialist merely to discover what your money is worth. Or you can leave the coins in Venice. You pay a trusted merchant there. He gives you a written order addressed to an associate in another city. When the document arrives and its identity is confirmed, the associate pays the seller in local currency. The silver in Venice never crosses the Alps. The silver in Flanders may never move more than a few streets. Only the debt travels. Long before the bank branch, merchants discovered something extraordinary. A promise made by the right person could move farther, faster, and more safely than metal. That promise depended on reputation, couriers, courts, and bookkeeping. One failure could shake trust across several cities. Yet this invisible system moved fortunes through a world without transfers, cards, or central banks. To understand how it worked, we have to abandon the familiar story that people first bartered, then invented coins, and finally created banks. Real economies were never so tidy. Money appeared in different forms in different places. Coins were only one of them. Long before coins existed, people measured value, recorded debts, paid taxes, and promised goods that would not be delivered until the next harvest. And long before institutions looked like modern banks, individuals performed pieces of banking from market stalls, temples, workshops, and counting houses. Money before banks was finance broken into separate parts. One person tested coins, another guarded treasure, another recorded debts, and another transferred value. The bank eventually gathered these functions beneath one roof. The earliest money was often not an object passed from hand to hand. It was a way of counting what one person owed another. In ancient Mesopotamia, large temples and palaces collected grain, distributed rations, and managed land, animals, and labor. Administrators needed common units to compare things that were physically different. Barley could serve as a standard for ordinary payments. Silver could measure larger values and long-distance obligations. The shekel was originally a unit of weight, not a round coin stamped with a king's face. A debt described in shekels of silver referred to a measured quantity of metal. A buyer could arrive with a coil, ring, ingot, or broken piece of silver. What mattered was not the shape, it was the weight and quality. This made the scale one of the first pieces of monetary technology. Without a trusted scale, a lump of silver was only a claim. The buyer wanted to prove that it was heavy enough. The seller wanted to know whether it was pure. Official weights reduced argument by giving both sides a shared standard. Mesopotamian weights were sometimes shaped like sleeping ducks, but their purpose was as practical as a modern checkout display, to turn material into a number. Clay tablets turned that number into memory. One surviving old Assyrian tablet records 6 minas, about 3 kilograms of silver owed to a merchant. It specifies when portions must be repaid, when interest begins, and who witnessed the agreement. The tablet was sealed inside a clay envelope whose impressions helped show whether it had been altered. No coins needed to sit inside the tablet. The clay itself was nearly worthless. Its economic value came from the obligation it proved. A monetary system does not require every transaction to be settled immediately. It requires an agreed unit, a memory of the balance, and a way to enforce final payment. In a small community, reputation might be enough. As strangers began trading across distance, writing, witnesses, seals, and courts made credit stronger than memory. Different societies selected different objects as money: grain, cattle, cloth, salt, beads, shells, and metal all performed the job at various times. Cowries were recognizable and countable. Grain was useful but bulky and perishable. Cattle stored wealth but were difficult to divide. Gold and silver concentrated substantial value into a small, durable weight. They could be divided, melted, and recombined. But bullion created a transaction cost every time it changed hands. It had to be weighed, it had to be tested, and the person holding the scale could cheat. Coinage reduced that friction. The first coins are generally associated with Lydia in western Anatolia during the late 7th and early 6th centuries BCE. They were made from electrum, a naturally occurring mixture of gold and silver. A small piece of metal received an official stamp, transforming it from anonymous bullion into a claim about weight and quality. The stamp did not create the metal's value from nothing. It reduced the time required to verify it. That saving was economically enormous. A soldier could be paid in standard pieces. A tax collector could count them. A market seller could recognize them. A state could demand its own coin in payment, forcing taxpayers to acquire the currency and helping it circulate. Coinage was therefore not only a convenience for traders, it was a machine for government. A ruler controlled the mint, selected the design, acquired metal, and struck pieces between engraved dies. The image announced authority wherever the coin traveled. If the stated value exceeded the cost of metal and production, the difference became revenue, what later economists would call seigniorage. The ruler had discovered how to sell certified pieces of metal for more than the metal alone. But certification created temptation. A government short of silver could reduce the precious metal content while preserving the coin's official value. Owners could clip tiny amounts from the edges. Counterfeiters could coat cheaper metal with a precious surface. Ordinary wear slowly reduced weight even when nobody cheated. The coin looked like certainty, but its value remained an argument. As Greek cities, kingdoms, and later Rome issued their own currencies, merchants encountered a flood of designs and standards. A coin trusted near its mint might be discounted elsewhere. Some widely respected coins traveled far because users trusted their weight and fineness. Others were accepted only after testing. This created a profession beside the market. The money changer sat behind a table with scales, weights, and tools for examining metal. He recognized foreign issues, separated good coins from doubtful ones, and quoted an exchange rate. His profit came from the spread between what he paid for one currency and what he charged for another. If the changer accepted a counterfeit or a ruler devalued a coin, he owned the loss. If customers suspected his scales, they disappeared. His most important asset was confidence in his judgment. The table also became a natural place to leave money, make a payment, or arrange a loan. In the Greek world, some money changers, known as trapezotai, took deposits and transferred balances. Roman argentari performed changing, credit, and payment functions. Temples, merchants, and wealthy households also stored valuables or extended loans. These were pieces of early banking. There was no single day when somebody invented the bank. What did not yet exist was a broad network of durable institutions offering standardized accounts and payments. Finance remained personal. A claim was only as strong as the debtor, the witnesses, and the court. If a money changer disappeared, the customer discovered that a ledger balance was not the same as silver in a hand. Keeping the silver created different costs. A household could hide coins in a wall, bury them in a pot, or lock them in a chest. Archaeologists find hoards partly because some owners never returned. Hidden wealth earned nothing. It could be forgotten, stolen, confiscated, or lost when a building burned. Hiring guards protected a treasure but consumed part of its value every year. The wealthy needed money to remain useful while they were not touching it. Credit made that possible. A harvest economy creates a gap between spending and earning. Farmers need seed before crops are sold. Merchants need cargo before voyages produce revenue. Spare silver bridges the gap for a price. The central difficulty was information. A lender might understand a neighbor's land and character, but financing a distant voyage meant judging storms, pirates, foreign prices, and a merchant who would be out of sight for months. Partnerships spread that risk. An investor supplied capital, a traveling merchant supplied labor and knowledge. They divided the profit. Collateral offered another answer by placing land, jewelry, tools, or goods behind a loan. Rulers borrowed against future taxes in much the same way. The money financed today's army, but tomorrow's revenue now belonged to creditors. Before independent banking law, finance lived dangerously close to political force. After Rome fragmented in Western Europe, local obligations were often paid with a mixture of coin, produce, and labour. Rent might be described in money even when part arrived as grain. People did not need a physical coin for every number in a ledger. They needed a common language for prices. As towns and trade revived during the medieval centuries, the old problems returned at a larger scale. A merchant travelling between commercial centres faced different coinages, tolls, and laws. Every bag of specie added weight and attracted attention. A large payment might require a pack animal whose only purpose was carrying the means of paying for the real cargo. Metal imposed what we might call a transportation tax on wealth. There was the wage of the guard, the cost of the animal, the lost cargo space, the danger of shipwreck, and the possibility of robbery. Even if every coin arrived, the destination money changer took a share. The more valuable the shipment, the more expensive it became to protect. Merchants began replacing the movement of coins with the movement of instructions. Across the Islamic world, instruments such as the suftaja and networks using hawala allowed value to be transferred through trusted intermediaries. In South Asian commerce, hunters performed related work as payment orders, credit instruments, and remittance devices. The exact forms differed by place and period, but the economic idea was shared. A payer gave value to one intermediary. A connected intermediary elsewhere paid the recipient. The two brokers settled between themselves later, perhaps through a reverse transfer, a shipment of goods, or the netting of many obligations. No individual coin had to complete the whole journey. Suppose traders in two cities repeatedly owe one another. During a month, 10 payments may be required in each direction. Shipping metal for all 20 transfers is wasteful. The traders can record every obligation, cancel opposing amounts, and move only the final difference. Netting turns 20 dangerous journeys into one smaller settlement. Its fuel is trust. Family ties, religious communities, and repeated trade made cooperation enforceable. But a stranger without references could face worse terms or no service at all. Trust lowered costs for insiders by raising a wall around outsiders. Medieval European merchants built their own versions of remote payment. Trade fairs became temporary financial centers. Merchants arrived with cloth, spices, metals, leather, and promises accumulated from previous transactions. Buying and selling happened during the fair, but settlement could be postponed until a designated payment period. At that point, the fair became a giant clearing operation. If a merchant owed one partner and was owed by another, the claims could offset. Money changers and merchant houses compared ledgers, converted currencies, and calculated final balances. Only the remainder required physical coin. The fair did not need to store all the wealth represented in its contracts. It needed enough trusted participants to agree on who owed what. Out of this world grew the bill of exchange. In a typical late medieval transaction, a merchant paid one currency to a financial operator in one city. In return, he received a written instruction requiring a correspondent in another city to pay a named person in another currency at a future date. The bill solved several problems simultaneously. It moved value without moving the same metal. It converted currency. It provided short-term credit during the journey. It created documentary evidence of the obligation. And because the return could be embedded in the exchange rate between cities and dates, it allowed profit to appear as exchange rather than a plainly stated interest charge. The paper was physically cheap. The network behind it was expensive. A merchant house needed correspondents, couriers, exchange information, skilled clerks, and enough reserves to honor bills before its own balances were settled. Most of all, it needed a reputation that had survived previous payment days. A bill from an unknown person was merely ink. One backed by a respected house could have a price before maturity. A holder needing cash could sell the claim at a discount rather than wait. Debt had become liquid. A coin settles by changing hands. A credit instrument creates a claim that settles later and may pass again before anyone demands metal. The same stock of coin could therefore support more trade because every transaction did not settle at once. The advantage came with a new kind of danger. If one merchant house failed, its unpaid bills could damage everyone holding them. Creditors who expected payment could no longer pay their own creditors. A problem in one city travelled through ledgers to another, even though no stolen chest or sunken ship could be blamed. Finance had reduced the physical risk of money and created network risk. The more connected the system became, the farther a failure could spread. Record keeping therefore became part of the financial infrastructure. A merchant needed to know not only how many coins were in the chest, but how much was owed by each partner when bills matured, which currency applied, and which voyage had produced each profit or loss. Memory and loose notes could not manage a business spanning several markets. Ledgers separated transactions by person and purpose. Debit and credit entries allowed merchants to trace value as it moved between accounts. Double-entry bookkeeping did not appear in one miraculous moment, and Luca Pacioli did not invent it when he described the Venetian method in print in 1494. Merchants refined these practices over generations because larger networks made error increasingly expensive. The ledger became a map of invisible money. It showed wealth that was not in the room, cargo at sea, silver owed in Bruges, a bill due in Lyon, profit assigned to a partner, and payment promised by a customer. For the first time, a business could see itself not as a pile of objects, but as a system of relationships. Governments developed their own strange record systems. In medieval England, the exchequer used wooden tally sticks to document payments and debts. A hazelwood stick was notched to represent an amount and then split lengthwise. One party kept one half, the other retained its matching piece. Because the grain and split surfaces fitted uniquely, altering one half would reveal the fraud. The technology was cheap, durable, and difficult to forge convincingly. Its most surprising feature was that a record of value could become valuable itself. A tally proving that money had been paid to the government, or that the government owed a payment, could be transferred or accepted in another transaction. Its worth came from the expectation that the exchequer would recognize it later, especially against taxes. The wood was not the money. The government's obligation was. Centuries later, tally sticks still appeared in the financing surrounding the creation of the Bank of England in 1694. A medieval accounting tool had survived to become part of an emerging modern financial institution. Tallies reveal why the boundary between money and debt is so difficult to draw. If a claim is widely accepted, reliably recorded, and easily transferred, people may use it in place of coin. It performs monetary work, even if final payment remains a promise for the future. Coin itself was also a political promise. The ruler said an official piece would be accepted for taxes and recognized by law. Debasement or recoinage changed the terms of that promise and imposed gains or losses on whoever held the old money. Merchants responded by keeping accounts in one unit while pricing actual coins separately. A trusted coin might trade above its official value. A damaged one might be discounted. Money remained two things at once: a physical object and a number agreed upon by a community. Money changers profited from standing between those worlds. Their benches, banca in Italian, helped give the modern bank its name. Over time, successful changes and merchant houses combined more functions. They accepted deposits, made book transfers, exchanged currencies, financed trade, and lent to rulers. The bank did not suddenly replace the pre-bank system. It grew out of it. The great Italian merchant bankers operated through branches and correspondence. Their advantage was not merely a vault, it was information. A house that knew prices, exchange rates, political dangers, and customer reputations in several cities could move money more intelligently than an isolated lender. Deposits supplied funds for loans, bills created exchange income, book transfers reduced coin handling. But a ruler might refuse repayment, a branch manager might hide losses, and depositors could demand money before long loans returned. The fundamental banking problem had arrived. Customers wanted deposits to be safe and available. Borrowers wanted funds for months or years. The intermediary tried to satisfy both with the same pool of money. As long as withdrawals were spread over time, the system worked. If too many depositors demanded coin at once, even a solvent house could fail because its wealth was tied up in loans and commercial claims. Before central banks and deposit insurance, confidence was not a pleasant addition to finance. It was the structure holding finance upright. Some cities responded by creating public exchange banks. The Amsterdam Exchange Bank, founded in 1609, allowed merchants to deposit a confusing variety of coins and make large payments through standardized ledger balances. The institution reduced the cost of testing, moving, and arguing over worn or debased currency. Money in the bank became cleaner than money in the street. Not physically cleaner, but economically clearer. A ledger balance represented a defined unit. Merchants could transfer it without carrying sacks between counting houses. The city's authority stood behind the rules. Personal trust had begun to become institutional trust. In England, goldsmiths with secure premises accepted valuables and coin, issued receipts, and increasingly used deposited funds in lending. Receipts and promises that were transferable could circulate beyond the original depositor. When a claim on a respected institution passed from person to person, paper began to perform the daily work once reserved for metal. The Bank of England, founded in 1694 to help finance the government, brought private capital, public debt, and transferable bank promises into a durable new relationship. It did not create money or banking from nothing. It built on centuries of tallies, merchant credit, goldsmith deposits, bills, and government borrowing. Modern banking was assembled from old inventions. The vault came from the need to protect metal. The account came from the need to remember obligations. The transfer came from merchant networks. The loan came from the gap between today's expense and tomorrow's income. The banknote came from making a financial claim portable. The clearing system came from cancelling many debts before moving the final balance. What changed was the scale at which these functions could be offered and the identity standing behind them. Before banks, trust usually attached to a person, family, guild, ruler, temple, or trading community. Access depended on belonging, reputation, and repeated contact. The system could work brilliantly across continents, but a newcomer might remain invisible. Banks turned that private trust into an institution that could outlive its founders. They hired clerks, standardized records, accumulated capital, built branches, and developed legal identities. A customer no longer needed to know every person who would touch a payment. The institution promised continuity. That promise allowed money to become less physical. When depositors accepted entries in a ledger, coins could remain in the vault. When sellers accepted banknotes, claims could circulate. When banks cleared obligations against one another, only a fraction of transactions required final settlement in metal. The complete cost of money began to fall. That cost had never been only the metal in the coin. It included mining, minting, testing, guarding, transporting, exchanging, counting, and recovering losses from theft. It included the opportunity cost of wealth locked in a chest. It included the time required to find a trustworthy lender and the risk that a distant promise would not be honoured. Every pre-bank innovation attacked one part of that bill. Weights reduced disputes over bullion. Coins reduced testing. Contracts strengthened memory. Partnerships spread risk. Money changes converted currencies. Bills, hawala, and hundi moved value without moving metal. Tallies made debt visible. Ledgers organized many claims. Banks succeeded because they bundled the savings. They did not make trust unnecessary. They manufactured trust at scale. This is why the most important money before banks was often not gold or silver. It was reputation. A respected merchant could write a cheap piece of paper that others treated as valuable. An unknown traveler could present a chest of genuine coins and still face delay, testing, and suspicion. The paper worked because years of honest settlement stood behind it. The metal struggled because nobody knew its history. Money was never valuable only because of what it was made from. It was valuable because people believed others would accept it tomorrow. That belief might rest on grain's usefulness, silver's scarcity, a ruler's stamp, a tally's matching grain, or a merchant's signature. Each system answered the same question: why should the next person trust this? Before banks, the answer was the weight, the seal, the witness, the ruler, or the merchant who had paid every bill for 20 years. The modern answer concentrated trust in an institution, its capital, records, and legal obligations. That concentration brought convenience and power. The institution guarding deposits could choose who received credit and create claims used as money. When it failed, damage spread beyond the room holding its coins. Money became easier to move because the machinery behind it became more complex. For thousands of years, people bought before they earned and transferred wealth without moving the object representing it. They wrote debts into clay, weighed silver, stamped electrum, split hazelwood, and sent payment orders across deserts and seas. The bank was not the beginning of that story. It was the moment the scattered pieces became a business of their own. Before banks, money lived in metal, grain, shells, wood, paper, and memory. But its deepest form was always a relationship between the present and the future. Someone gives value now. Someone promises value later. Everything depends on whether the promise survives the distance between them. The great achievement of banking was not the invention of money. It was the construction of an institution capable of making millions of private promises look like one reliable public system. Before that institution existed, merchants had already learned the essential trick. They could leave the treasure where it was. They could send the debt instead. That was the